Proof that buying real estate in an IRA is better than owning it personally. Hey everyone, Adam Bergman, tax attorney and founder of IRA Financial, and welcome to another episode of Adam Talks. On today's podcast, finally going to give you the goods. I am going to show through an example and prove to you what I've been saying for years, that owning real estate in a self-directed IRA makes far more tax efficient sense than owning it personally. And I'm tired of people telling me about depreciation and deductions and losses. I'm going to give you a real life example to show why and how, through the power of deferral, compounding returns, why owning real estate in a self-directed IRA is so powerful. So I'm going to share my screen and just provide some facts for those who are listening. I will kind of read through the facts. If you're watching on YouTube, I will share my screen for a portion of the podcast just so you can kind of get a lay of the land as to where I'm going. But here are the facts. It's a basic example. I've used Chris. Assume he's 45 years old. He's in a 32% tax bracket, and he's got an IRA worth $300,000 for example purposes. And let's say he wants to use $250,000 to buy real estate. Okay. He's got his IRA Fidelity and he hears about IRA Financial. He finds us online. He submits information online. One of our amazing tax professionals gives him a call back and they discuss the structure, and he elects to set up a self-directed IRA with an LLC to give you the limited liability protection, as well as give him a little bit more control to handle and manage his self-directed IRA investment. Okay, so he puts in $250K and buys the real estate. And it's not important where the real estate's purchased. The numbers is really what matters. So let's assume for over the next 20 years that the property generates $10,000 per year in rental income. Okay, net, which is deposited back into Chris's self-directed IRA account without tax, right? That's known as tax deferral. And over 20 years, 20 times 10,000, that's $200,000 in rental income that would go back to his self-directed IRA without tax, right? There is no tax on any of the income or gains from a self-directed IRA investment. So that net rental income is 100% tax deferred back into Chris's IRA. Okay, now let's assume, for example purposes, that the property appreciates at a percentage of 5% a year, so that after 20 years, assuming 5% appreciation a year, the property will be worth approximately $663,000. Okay, and trust me, the math is right. I checked it through ChatGPT. Now, with all seriousness, I did the math. It works. It's based off a real life example, and 5% a year is pretty conservative, especially over the last 4 or 5 years, where properties have doubled and tripled literally in 3-4 years. So based off this example, Chris, $10,000 in net income over 20 years, that's $200K. And assuming the property from $250 went up to $663 after year 20. So now we're in year 20, right? And let's assume Chris sells the property for $663. So if you take the $200K of net rental income that went back tax deferred into the IRA and the $413,000 of gains, right? The $663 minus the $250 Chris paid for the property, it's $413 plus $200, that equals $613,000. And you add that to the $250 he started with, Chris would have $863,000 after year 20 in his IRA without tax, right? Again, $200,000 plus the appreciation of $413 plus the $250 he spent on the property. So he's got $863 and he had a gain of $613,000 from this investment over a 20-year period. Okay, since it's in an IRA, it's all tax deferred, and all $613,000, the $200,000 of rental and the $413,000 of appreciation go back to the IRA without tax. So now let's assume he paid with personal funds, non-retirement money. So forget about the example I just mentioned with Chris. We'll use the same facts, but let's say he doesn't have an IRA, never heard of IRA Financial, and he just decided to buy the property with the $250,000 of personal funds, non-retirement. Okay, still gets the $10,000 a year, right? But remember, now that's going to be subject to tax. So we said he's 32% tax bracket. So out of the $10,000 net, he's going to be left with $6,800 a year. Okay, remember, right? That's one of the advantages. The IRA, the 10K goes back to the IRA without tax. In the case of owning the real estate with non-retirement money, 32% of that goes to Uncle Sam, so he's left with $6,800. And if you take the 3,200 and remove that, he's left with 6,800, and you times 6,800 times 20, that's $136,000, right? So he had $200,000 in his IRA on 20 years of $10,000 of income. Now Chris only has $136,000 if he bought the property with personal funds, right? Because he had to pay tax each year on the net rental income. So now Chris sells the property, same facts, $663,000. He's going to owe capital gains on the $413,000, right, of appreciation, $663,000 minus $250,000, assuming 20% capital gains tax rate, which is actually lower. It'd probably be higher because there's also Obamacare. That's $82,600 in taxes, leaving him with $330,400 plus the $136,000, giving him $466,400. So let's compare the two outcomes, right? You got the same facts. Same Chris, $250,000 for the property, $10,000 of net rental income, sells the property, 5% growth a year over 20 years, sells it for $663,000 in both cases. So if you use the self-directed IRA, at the end of 20 years, he's going to have $863,000 back in his IRA. $250,000 started with $200K in rental income, $413,000 in gains, all tax-free back to his IRA. Now, if it's a traditional IRA, when he pulls the money out after the age of 59.5, he'll pay tax. It's a Roth IRA, so long as he's over 59.5, the Roth's been open 5 years, all tax-free. So now going back to the non-retirement option of Chris, after 20 years, instead of being left with $863,000, he's only going to have $466,400. Isn't that crazy? So he's going to almost lose $400,000 or so, $420,000 less because he used personal money, right? Because he loses on the rental income. Instead of having $200K, he's going to have $136,000 because of the tax. Okay, so there's the loss. And then on the appreciation, because he's paying the $20,000 in capital gains, he's losing another $82,000 in taxes, leaving him with just $330,000. Okay, so instead of having $413,000, he's having $330,000. If you look at the $330,000 and the $136,000, he's got $466,000, and then the $250,000. So he's losing, instead of $863,000, he's going to walk out with around $710,000. So he's losing about $160,000, okay, in his IRA total asset value. $863,000 and then the $466,000 plus the $250,000, which is, around $710,000. So he's losing about $150,000 or so just by not using a retirement account. Okay. And then again, if it was in a Roth, he'd have the added benefit of pulling all the money out tax-free. So you'd have the added benefit of having that money continue to grow without tax and not pay any tax pulling that money out. If he had a traditional IRA, he'd pay tax on whatever he pulled out, but the money in the IRA would still grow without tax, and he can do another real estate deal, or he can do any other investment he wanted. So just by not using retirement funds, he lost $150,000 by making a bad decision. So this is a perfect example, I believe, of why using an IRA to buy real estate in a self-directed IRA structure gives you more money, more diversification, and longer-term asset creation, wealth preservation, just by making the simple choice of using a self-directed IRA over a non-retirement account personal fund option. And it's just comes down to three-letter word, tax. That's all it comes down to. The rental income in the example, each year that $10,000 gets reduced by the $3,200 of his tax bracket. And then when he sells a property, he's going to lose the capital gains 20-something%. And there's also something called depreciation recapture, which is at 28%. And potentially there's, depending on how high the capital gains is, there's an extra Obamacare tax of 3.8% on top of that. So the 150 or so of savings actually would probably be a lot higher. He'd probably save 160 165, 170 by using the IRA versus personal funds. Now, the one pushback I always get from accountants and some clients is, Adam, I get you. You're right. On a tax basis, it makes sense. But what about depreciation? What about deductions? I'm not going to get any deductions with my IRA, and deductions are valuable. Fair. But people don't realize that, number one, I mentioned depreciation recapture. All depreciation you took, you got to recapture that, pay 28%. And there's something called passive activity loss limitation rules under section 465 and 469. If you're not in the real estate business, you may not be able to use all those real estate losses to offset ordinary income. So if you're a passive real estate investor, the passive activity losses under 469 and the at-risk rules under 465 will generally limit your ability to use those losses to offset active income if you are not a real estate dealer or an active real estate party. So something to keep in mind. For me, I'd rather shelter my gains and income from tax than deductions. I'd rather pay no tax and get deductions. That's just me. I'm a tax lawyer. Maybe I'm wrong. In my case, my experience, my dealings with clients, pay no tax is better than generating deductions. Now, if you got a lot of losses and you got a lot of income and it works out and you're not a passive real estate investor, you can use some of those losses to offset active income, then it could work for you. And that's why, it's facts and circumstances. But I truly believe, as a general statement, not paying tax and having your money grow without tax and taking advantage of compounded returns is far more important and far more significant than getting deductions, to offset other income. That's my personal tax take on this. So that's the purpose of today's podcast. Hope it made sense. Light bulbs should be kind of blowing up in your head saying, oh my God, that's crazy. I can't believe I have an IRA or I have a 401k. This is crazy. I can do all this stuff. And yeah, you got to be patient. The beauty of real estate and an IRA is they're generally long-term investments, right? Yeah, you may fix and flip a home in a year or 6 months, but a lot of people will hold 5, 10, 15, 20 years. And this example, you could spread this out over 5 different investments, right? I just picked an easy example of one property over 20 years. It could be 5 properties over 20 years, right? The concept is this: the rental income is going back without tax. When you sell a property, you're not paying tax. I don't care if it's capital gains, ordinary income. You're not dealing with depreciation recapture. You don't have to deal with basis. You don't pay any tax. Zero, nothing, nada, assuming there's no leverage being used. So for cash-based IRA investors, using an IRA over non-retirement funds, as the example shows, the numbers don't lie, is the smart way to invest. It's the most tax-efficient way, and it's the best way to accumulate real, significant, and greater wealth in your IRA than you would have otherwise been able to do using personal funds. So that is it for today's podcast. Hope you enjoyed it. Thanks for listening. If you're watching on YouTube, really appreciate it. Thanks for all your support. If you have questions, comments, please leave them. Love to hear from all of you. And look forward to seeing everyone again next week on the next Adam Talks. I'm Adam. Thanks for listening and have an amazing rest of your day. Ciao.